Lucy, it's Casual Friday here at Lex Studios. We're wearing jeans. I don't have a tie on, but still I am anxious. We had lousy job numbers or weak job numbers in the US today. There was various bits of bad news coursing through the market all week. You are our Chinese correspondent from your perch in Hong Kong. Give me something to be reassured about from China.
Well, this week that's a little bit tricky as well. We had a few bits of data out in China this week, even though most of the market is on holiday for the National Day. Happy birthday, China. We had industrial profits, which were down 9% year on year for August, which is quite a significant acceleration in contraction.
Yes.
From July.
Falling faster.
Yes, falling faster. And we had PMI that didn't really pick up both on the manufacturing and also more worryingly on the services side, because that's been the area that the government's really been trying to focus on shifting the economy towards.
You're doing a terrible job making me feel less worried about things, Lucy. Try harder, please.
Well, within that, there was another data point that came out today, which was this week, which was the Westpac MNI Consumer Survey Index. Again, just another survey, but it showed the strongest level since May last year. So that includes the entire period. So May last year, obviously, was
consumer sentiment.
Consumer sentiment, yes.
Right.
So obviously, it's been weaker ever since May, despite the stock market rally and everything, and now a strong number in August, the strongest since May last year, despite the stock market collapse as well. So it seems to be completely independent of that, and consumers are positive on current finances, the business outlook, and also, in fact, the property outlook as well.
And we saw the car companies rally this week on a little bit of good government news, as we spoke about earlier.
We did.
Which sort of fits into that theme of the Chinese consumer kind of hanging in there.
Well, I think the government, so there were two things that the government did this week. They implemented fiscal stimulus. So they cut purchase taxes on cars in half, from 10% to 5% for 1.6 litre engines and below. And they also cut deposits on first-time buyers' property purchases in non-tier 1 cities. Is a little bit convoluted, but basically new property buyers can now put down 25% instead of 30% deposit, which is reasonably significant.
So sitting on the outside, as I do, looking in, thinking from an investor's perspective, the market broadly has been ravaged. Am I buying property stocks? Am I buying car stocks? Am I still staying as far away as I can? What are your thoughts?
I think the auto stocks, there will be short-term fillip from this, which we discussed the other day, but I think property does look quite interesting. Prices have picked up in markets such as Shenzhen and Shanghai. New starts haven't really picked up yet, which is good news, actually, because it means there's potential for more absorption of supply. And Chinese property owners themselves Chinese non-property owners, Chinese consumers themselves see property as a reasonably secure asset, and particularly in this environment where the stock market's been falling. So property prices and property as an asset class stands to do quite well, and Hong Kong listed property stocks as well on the back of that.
Lucy, I feel so much better. Thank you.